Leo Kelly joining us right now, Verdant's Capital Advisors CEO. He's seen it all along an illustrious career that I think started from somewhere good. Now you're in a much better place, Leo. When you look at this rally in AI stocks, do you think that there's something there to actually go after?
Well, it's interesting, Romaine. When I was at Bloomberg starting my career, the tech stocks were taking off in the 90s, and we were starting to reach some really spectacular heights. And I heard a lot then what I'm hearing now, that it's different when the businesses have earnings, that the industry is going to be a constant growth machine, and that ignore valuation. What we also saw was price targets just getting raised for the sake of them crossing the old price target. So valuation matters. People discovered that in 2000, and it wasn't just the pets.com. It was Cisco, it was Microsoft, all corrected. So I think you have to focus on valuation.
Well, I want to go there too. I'm glad you brought that up here. I should point out too, I actually, at one point in my career, I actually interviewed the pets.com SOC, by the way, which was the highlight. But a lot of people, and I'm just going to play devil's advocate here for a second, Leo. Sure. Some would say, okay, this time around, what's being bought are NVIDIA's and Microsoft's and companies that have well-established track records of revenue growth, profitability, et cetera, unlike maybe, I guess let's just face it, there was a lot of garbage floating around back in the late 90s, early 2000s.
Well, there was a lot of garbage, but there was a lot of great stocks. Microsoft was great, and when it collapsed starting in 2000, it didn't make a new high for a couple decades. Cisco was a wonderful stock that went from 90 to 9. And I'd point out, everything they said about the internet came true. Every wonderful story that came about came true. Now, by the way, Romaine, what we also had was Netscape. And Netscape turned out not to be the clear winner that everyone thought it was. It turned out to be Google. So don't get me wrong. NVIDIA, great company. Apple, great company. Microsoft, great company. But those three stocks are 30% of the S&P 500's gain this year. They are running, and they are running quickly. The problem with the bubbles, and whether this is the beginning of or a more mature in, and I think we're in the middle, is that they can go anywhere, and it's impossible. So the Barclays call we talked about earlier isn't really brave. They're just taking the trend, and they're calling it higher. And the trend will continue to go higher until it doesn't. And you never really know what turns that over. We like to tell our clients, stay diversified, focus on valuation.
Well, when you think about valuations, I mean, even if you're not in the business of trying to pick which will be the winners of this AI boom, who will be the Google, the Amazon of this AI boom, you can't ignore it at the index level when it's inflating the valuation of the index. And with that in mind, I mean, are you staying away from the S&P 500, the NASDAQ 100? Where are you actually looking for that diversity?
Yeah, that's such a great question right now specifically. We are in the camp that the S&P 500 and NASDAQ are being blown up through just a few names. There is some value in this market. It's at the bottom level of the market. It's in value. It's in small cap. It's in international. But it's also in cash. You know, it's an interesting moment in time we have here. We finally have a rate of return on cash. So holding a little bit of cash on the sidelines, now it pays us. But more importantly, we believe the opportunity value of that cash is going to be very valuable. I heard earlier us talking about the Fed and interest rates. The Fed is going to be aggressive because just because we've seen 4% inflation does not mean we're out of this thing. More inflation is coming. We have not significantly impacted M2, the supply of money, enough to combat inflation. So we're in the camp that the economy has maybe a little bit more turmoil in the second half of the year and early in the following, and then we come out of it and we'll be fine. So I would definitely say cash is your friend, value, small, international, all good places to be.
And Leo, we don't have much time left here, but on cash, you've heard some warnings just in the past couple of weeks that there is a cash trap to avoid. When does cash continue, or when does it stop working? Does that really depend on when we get the first rate cut?
And again, I don't know that we're getting a rate cut for a while. I think the market's missing that M2 went up 40% over 2 years, and it's only pulled back 4. I think we have a while for that. I think cash is safe for the foreseeable future, and we're going to get a rate of return. Now, it may bounce around a half a point or so back and forth, but I don't think we're running back down to 1. But again, I would remind the viewers there's two returns to cash: the yield and then the opportunity value. If you're holding cash and this market gets hit and we go into recession and you see a pullback of 10, 15, 20%, having that cash becomes immeasurably valuable, far more than the actual yield that the cash is paying at the moment.
All right, Leo, great stuff as always. Leo Kelly there. He's the CEO over at Vernon's Capital Advisors. Continuing our program.